Listen closely. This whole startup game, those crazy jumps in valuation, you think founders alone move that needle? That investors just throw money and it skyrockets? It's way messier. And here's the brutal truth. Limited partners are sitting on a power so few even notice it. You've been told you're just a silent check, a passive player. That's a lie that's costing you and everyone else millions in opportunities. Look, founders cry out for more than capital. They need validation, credibility, connections burning sharp and fast. When a valuation shoots up overnight, it's not magic. It's a vote of confidence from deep inside the system. Limited partners, you, hold the ultimate vote, but nobody tells you how to use it. So you either stay quiet, hoping for returns, or worse, chase safe bets, churning mediocre portfolios that never shake the ground. But guess what? You can force the market to value startups properly. Not by throwing random dollars or waiting for hype cycles, but by being more than just cash. You must become the signal. The reason a founder's idea stops being a whisper and becomes a roar, investors cannot ignore. Here is what you do. First, own your voice. Get brutal about where you put your weight. Stop pretending your check alone fixes anything. Bundle your network, your insight, your reputation, make it unavoidable. When you lean in, that startup's valuation isn't just numbers. It's the market seeing you back it, seeing you believe. And belief is contagious. You've got to cultivate that. Second, move beyond the spreadsheet. Dive deep into understanding real operational risks and growth levers. Be ferocious in your due diligence, but not just for risk. Use it to uncover potential market shifts others ignore. Then feed that back to founders early and loud, shaping their trajectory with actual pressure, setting hard benchmarks that translate into multiples. Don't sit on the sidelines criticizing strategy. Be the force pushing it forward. Third, create scarcity. Don't open the floodgates for every startup. Limited capital isn't just a limitation. It's an opportunity to sharpen focus. When you truly constrain access and create exclusivity in your deals and rounds, valuations surge because being in your fund means something serious. Founders will fight harder to prove their worth if you're not the fallback check but the litmus test. Fourth, don't just participate in governance, command it. Board seats and advisory roles aren't trophies. They're levers of change. Push founders hard on strategy and execution milestones linked directly to valuation inflection points. Hold them accountable not just to growth, but to the precise narratives and metrics that valuations respond to. Your power is to push, prod, demand clarity, and act as a reality check that startups so desperately need. Finally, you need to build your own ecosystem. Don't rely on fame or conventional networks. Make your collective intelligence your edge. Align with others who don't settle, forged on trust, brutal honesty, and shared goals. Pools of limited partners working together become a torrent, not a trickle. You become the force startups crave. You reboot what valuation should mean, a real measure of potential activated, not just dreamed. Wake up. Your impact is massive, but dormant. Stop signing checks in silence. Take these steps, and suddenly, you don't just watch valuations jump, you shape the future companies that build the world. You're not just limited partners. You're decision makers who hold the keys to who succeeds and who fails. Use that. Demand more from yourself. Get involved, get loud, get precise. Because only then does valuation jump mean something real, and only then does your money turn into legacy. Subscribe to our YouTube channel and check the featured link to discover more.